social media home for workouts, capital raising professionals. What are we? Workouts, special situations, and capital raising professionals. Doing these shows twice a week has helped me lose my flow just a tiny little bit. Today we're focusing on the capital raising part of our, I guess, our bailiwick, if you like. Although there will be some overlapping to the special situations. There's a lot of money around, as we know. Money is very cheap. It could be said that in some situations money is very easy, and yet we're hearing that certainly in the SME space and also in the lower middle market to middle market, getting money is not necessarily easy, particularly out of the bank. So there's a bit of a paradox going on there. Very low interest rates, money is in abundance under certain circumstances, and yet where the rubber hits the road, getting the right kind of money is still challenging in some circumstances. And so we have got two guests to talk us through this and to tell us what's going out there in the real world when it comes to actually raising money for real life clients. And the first of those guests is Andrew Clark.
Hey. Good, thanks. How are you?
Very well indeed. I have to say that because we are getting busier, and as a result,
Sure.
We've got less time to sort of get our panel down perfect. So I guess it's all a little bit off the cuff and rough and ready. Listen, you are a CLFP, and you have also recently won the Broker Firm of the Year with the Commercial Asset and Finance Brokers Association. So, what's a CLFP, and what is what's CAFBA to begin with?
CAFBA is the Commercial Asset Finance Brokers Association, which is our broker industry body. That sort of is a bit of a go-between between the lenders and brokers like us. They do a lot of CPD things and help us out with that, and a bit of rallying, between us and government and things like that as well. So that's our industry body, I guess, is the short answer to that. And the CLFP is actually a qualification which is more common in the United States. There's actually only two CLFPs in Australia, which is myself and David Gill, who's the CEO of CAFBA, who we were just talking about their organisation as well. So CAFBA is trying to bring some education and improve that area of finance broking. So they're bringing a CLFP type qualification to Australia. So David did it first, and then I did it after that.
I have to say, I guess, yeah. So you're basically saying there's three things. I'm sure that if there's CAFBA people watching, they might say, "Hang on, what about things 4 and 5?" The professional standards for the industry and the whole industry,
Yep.
The professional standards have been raised, and there's absolutely no question about it. It's fantastic.
That's right.
Also, obviously, acting as a go-between, as you say, between the finance brokers and all the lending institutions, and importantly, of course, the major banks, who are heavy supporters of CAFBA. And the other thing, of course, is as a lobby group to the government. I know that they have lobbied, whilst I guess ostensibly they're lobbying hard for the finance brokers, they are also de facto lobbying for small business, because when the government gets one of these thought bubbles about what a great idea for small business,
that's exactly what I was about to say.
Yeah,
that's exactly through lobbying on behalf of brokers like us, but we're servicing small business. So one step away, they're lobbying for small business for sure.
Now tell me, so how your firm has only been going for a couple of years. How did you manage to be Broker Firm of the Year in such a short space of time?
Well, we did a bit of a rebrand. So whilst technically, we've this business was started in March 2020, which is probably, if people are thinking about that, it's a significant date for other reasons as well. But we started in March 2020, but we were a rebrand of an existing business. So we did have a little bit of a head start in that on that level, to be honest. But so we
start a business just as the world's going to hell, is what you're saying.
That was pretty much. We started as Danforth Finance Insurance on the 1st of March 2020, and I think it was about the 16th of March where we had ScoMo on the TV saying that everything was going to close down. So that was certainly a pretty challenging time to be rebranding your business.
And what's the nature of the work that's crossing your desk at the moment? Is it small stuff, big stuff, any industry?
Boy, at the moment, it's really anything and everything. From cars to small pieces of equipment, larger pieces of equipment in construction, manufacturing, fit outs, large scale fit outs, solar farms. The dollar range on my desk at the moment is a $25,000 car to a $20 million solar farm. So it's and everything in between. So it's there's a vast sort of range of applications at the moment on my desk.
And how would this? I mean, how would business at the moment compare to say 2 years ago, pre-COVID? Is it at pre-COVID levels? Is it patchy? What's the
look? From where I sit and our numbers, in terms of a number of transactions, we're probably down 15% to what would have been an average in, say, 2019. But I'm certainly not unhappy with it. I think that's quite good in this market. I'm really happy. Not sure if every business is similar. I think obviously it depends on the industry. Like if you're in hospitality or something, for example, you're certainly not 15% down. You're a lot more than that. So.
All right. Well, look, we will put you back in the waiting room and introduce our second guest for the day. And we're going to introduce Arthur Psaltis. G'day, Arthur. How are you going?
Hi, Nick. I'm well, thank you.
Now, Arthur, you're the managing director of VMG Capital.
Yes.
VMG, of course, is an abbreviation for Velocity Made Good, which is a sailing term. And I know that you're a sailor and a City of the Hobart Cup winner, which is another story that you might touch on as we go. Now, you do capital raising, but you also roll up your sleeves and do a little bit of what you might call certainly strategic advisory work and turnaround work as well. Tell us a little bit about the sort of work that you've been seeing lately as a bit of a flavour for what you do.
Well, as a way of background, we're very much a corporate advisor to the middle market, and that's $10 million type turnover companies up from there. We're working across a range of industries, and it's all about using the 25. We've probably had more than 25 years in the multinationals in financial services. We're talking banks globally, and what we're trying to do is bring some of that know-how into the middle market, so it's connecting capital. But I like to summarise the type of business we are is that we're like a psychiatrist company. So we're trying to differentiate ourselves away from being a corporate doctor, but it's about the analytics of the company, trying to work out where their issues are, and then working with the company to improve on their performance. So we're across industrials, professional services firms, real estate, primary industry, renewable energy. And so what we're seeing in the current market, we've got a good cross-section across corporate or mid-corporate Australia, and we're seeing, all the stuff we're hearing in the press is for real around supply chain interruption, lack of access to labour, and it's really having an impact. I think a short-term impact, probably less than the next over the next 12 months. It'll work itself out, subject to the virus not getting any worse. But but we're in the freight world. We're seeing in the national freight a significant change in that market, and the labour structures that are being employed in that market. The importers. They're struggling, seriously struggling with their freight costs. So a whole cross section of industries.
And do you obviously you spent some time at fairly senior levels at Westpac and the NAB. I mean, is that the sort of space that you're playing in with the major banks or alternative capital providers as well?
Well, look, Nick, the major banks are always on the radar, and as companies are growing, if they can get the access to that low cost capital, then that's obviously an advantage. A lot of the companies we're dealing with are accessing into the non-banks, and that is a market, it's a growing market, rapidly growing market, not as deep as the European or North American markets. So there's a lot of arbitrage goes on in that market. There's a lot of mispricing going on in the non-bank market. But having said that, lot more entrants, particularly over the last 2 years. A lot more entrants in that space. So we're working across non-bank lenders, bank lenders, private finance, private equity, venture capital. We're across all the various capital parts of the balance sheet. And as I say, the non-bank space is awash with capital and a lot of opportunity to be had in terms of finding the right home for the right capital solution.
Okay, and I know that I think the first time I met you, it was you were getting deeply involved in the numbers, trying to find out what was wrong with the business. I think you said basically it was analytical work to begin with, I suppose, diving into the data and trying to work out what was wrong. So, is there much finding where the money's hiding on the balance sheet, that sort of stuff? I mean, how do you go about that? Are you using particular programs, or you're an accountant by trade?
Yeah. So background is part of accounting. What we've created is the VMG diagnostic, which I effectively call Australian consulting as opposed to American consulting. So we've used many years of experience in financial services. We ask 100 questions of the company to the owners of the company to identify where the pain points are, and that's from that diagnostic you get a score out of 10, and very easy conversation. If you score less than 3, we can't help those companies, and we introduce them to the right people. But where they're between 3 and 7, that's where we're trying to help companies grow, and invariably it's access to capital. So we end up making sure before they present to the capital providers, we've got to make sure the company's fit and ready to be able to present. So we spend a bit of time getting the companies fit and ready, and that's across systems, processes, people, controls. We all. You're an expert in this space. You know where to look as a non-bank funder, and so we know what the funders are looking for. So our job is to get the companies into a place so that they present well, and the better they present, the lower the cost of capital. It's that simple.
Okay. All right. Well, we will bring back Andrew Clark. Now, Andrew, before we sort of get into discussion around the particular challenges of placing deals and what sort of deals are difficult and etc., I'm just interested. Finance broking has changed a lot over the years. Once upon a time there were some pretty large firms dominating the place, and the large firms obviously still they're still there, and but I suppose one of the advantages of working under the banner of a large firm was that A, there was the sharing of overheads, and B, there was obviously accreditation, so getting accreditation with the banks, etc. But I guess these days there's technology and there's aggregators. I mean, how does that change the way you run your business? I mean, you're not a large firm as such.
That's right. Well, I mean, aggregation's been around for quite a long time, but I think they have improved their systems and technologies pretty quickly in the last few years. And you're seeing even the larger firms now are using aggregators as well, which goes to show that value of simply being a larger firm is probably diminishing a little bit because you are seeing them go to aggregation models as well, which shows the value of them, right?
Yeah. Okay. All right. Well, okay. So what? Let's turn our mind to what scenarios are challenging at the moment. We know that with low interest rates and that there's lots of new lenders, and there's an abundance of capital. There's new credit funds, and there's a lot of equity and private equity. So there's a lot of money about the place, but it's not always straightforward getting deals set. I mean, what do you find, Andrew?
You're right. I think the biggest challenge recent, over the last few years, would be meeting regulatory requirements, particularly with banks. And I think Arthur touched on that a moment ago, where he was sort of saying that there's a bit more sort of non-bank lending is becoming more attractive to people. And I think that might be just an opinion based on regulatory issues, where some of the non-banks are not lumped with as much regulation as some of the non-bank lenders.
Yeah, so regulation's the main thing. And where the rubber hits the road, what does that mean? More paperwork, slower processes?
Both of those things. That's what I'm experiencing as well. I mean, I mentioned earlier, we're a little bit down, but we're doing a similar amount of business. But I think the work that's involved in doing that similar amount of business is probably 30-40% more work, and it is a lot of it is form filling and box ticking sort of stuff. That's what I think.
Okay, well, Arthur, before we went live, you mentioned the business relief loans. What are they called? Those COVID relief, the business recovery loans. Yeah, and just tell us a little bit about those.
Well, look, I mean, and particularly small and medium-sized businesses, but what we're discovering is that certainly the mainstream banks are struggling to get these loans approved and out the door, because they're trying to just provide the background. They're largely guaranteed. They're not 100% guaranteed, but they're largely Commonwealth government guaranteed loans. So significant reduction in the risk ratings for a bank. The banks are still treating them as if it's a normal credit, and we've got examples on our book at the moment where companies are not getting approval because they don't meet guaranteeing the loan. It's quite interesting. It comes back to Andrew's point. It pushes them back into the non-bank lenders.
And what about yourself, Andrew? These things are 80% guaranteed by the government. I speak to some brokers and they say, "Oh, that's all we're doing," but other brokers say that the banks have just got no interest. So, how do you find it?
Well, we haven't done one of those loans for the same reasons that Arthur's mentioning there. I mean, as I see it, they're designed to help some businesses that might be struggling with the effects of what's happened with COVID. But then that will often be the reason that the bank is identifying the reason that they can't do the deal, because the business has been struggling.
Yeah.
So what do we say about that? It's a bit sort of counterintuitive, isn't it?
So, like Arthur's saying, you're not finding that the banks are going, "Oh, well, the government's going to wear 80% of any loss, so we're going to be a little bit more cavalier." It's business as usual.
I'm not seeing that, no.
Yeah. Okay.
Nor are we.
Okay, and Arthur, I'm just wondering, what about when it comes to credit assessment? Because you've touched on, you've said that the banks are treating these things the same way they treat any loan. So just sort of moving away from that particular support that the banks, the government's giving, how are banks assessing credit they're looking at financials and going, okay, well, there was a drop in revenue and a drop in profitability, but that was because of COVID. Are they overlooking that? Are they looking back to financials of 2019, or what metrics are they applying to make decisions, given that there's a gap in the financials?
I mean, I really don't think the credit process has changed from pre-COVID. I think they're very focused on the financials, the EBIT and EBITDA, so the cash flow generation capacity of businesses. And frankly, our experience is the banks are looking at performance through COVID, and it becomes quite circular, as we've been talking, because companies have been weakened through COVID, whether it be supply chain or whether it be just at the revenue line. But the banks, they're looking at the cash flow generation, and they've been quite. I would say it's the flow of capital at that banking level has been quite difficult. We're talking companies that rate, say, 5 or less on the VMG diagnostics. They're not performing well, but there are good reasons why, and particularly around COVID. So, having said that, there's a lot of liquidity in the non-bank space. So we're working on transactions at the moment on a real estate trade where it's development capital, and it's single-digit funding, first mortgage funding on development risk, development and construction risk. To that point, I think there's good liquidity in the non-bank market, and the bank market is business as usual.
And Andrew, what about yourself? Are you finding that if you've got something where the financials are a little bit impaired, in 2021 financial year, which was the year when COVID was sort of the most devastating, are you finding the banks giving borrowers a leave pass, or just analysing as usual?
It's a difficult one. Good question. I think that they are factoring it in, and I believe that they're trying to sort of act commercially and not sort of prohibit businesses from borrowing based on a poor performance during COVID, which often was no fault of management of the business. But at the same time, they've still got to assess their credit, don't they? So I don't want to criticise them too much, because it's a tricky balance.
Mm-hmm.
Yeah. Okay. Mm-hmm. Well, let's go through the types of capital raising. Obviously, the one that you're doing the most of, Andrew, is new equipment. So new equipment is easier than, say, capital raising against existing equipment.
I would say that the banks in particular probably do look a little bit more favourably at new equipment and new purchases, as opposed to capital raising on existing unencumbered plant equipment. There's been a sort of a perception in the past that if somebody's trying to raise capital against their unencumbered plant equipment, then that means that they've got some sort of problem, and therefore we don't want to look at them. That has been a past perception, which I think was a little bit harsh, and that's why it is easier to get finance for new equipment. Like, that's very broadly speaking, though, by the way.
Yeah. Okay. And Arthur, what about? I'm seeing a lot of companies are accruing tax debt. I think that ATO arrears is a bit of an untold story at the moment. No one's really talking about it. People in my circles are talking about it, but I think out there in the general populace, someone told me last week that SME debt is now up to 55 billion. And a lot of companies they've got masses of unpaid ATO debt. So typically that's an obstacle for the main banks. I mean, I guess, what do you find?
That's definitely the case. Having said that, I know that the four majors will, as long as the tax debt is down into, if it's around the $40,000 to $50,000 mark, they will consider advancing or giving credit approval with that type of debt. So we're talking relatively low tax debt. The reality is, if anybody is going for a credit approval, any corporate, and they've got significant tax debt, they can really basically they'd be wasting their time banks in my view. Unless they can show that it's on a fast track to being paid back. So it's a bit of a double-edged sword because it's very low cost funding. And as you say, the tax office over the last 2 years has been very, I would say, generous in the way it's dealt with it. So it's something that has to be managed, and our advice to clients is to clean that debt up, even though it's low cost capital. That really needs to be off the balance sheet because it very significantly limits your access to other forms of capital, any type of other capital.
Okay. What about yourself, Andrew? How are you finding that?
Exactly, Arthur just summed that up actually perfectly there. So you are sort of seeing that the majors are okay with a limited level of tax debt, but there are lenders out there as well who have strict policies that say if you have tax debt over a certain dollar figure, it's an immediate no. They won't lend to you until that's sorted out.
Yeah, I know that CAFBA over the years has sort of tried to bring the ATO and the banking community together in terms of helping banks, I guess, look past the tax arrears situation, particularly where it's under arrangement. I must say, I was talking to a couple of boys from Tax Assure who do the tax debt negotiation, and they say that the ATO is going to start getting active again, but I guess we'll have to wait. And see there. Arthur, given that you're sort of more in the corporate space, corporate advisory space as well as capital raising, but are you seeing much call for in the work that you're doing? Are you doing much mergers and acquisition type stuff? Helping people sell their businesses or help them grow through acquisition.
Yeah, Nick, we are. It's really. Without a lot of the clients we're working with, they're in a growth phase, and so whether it be acquiring another or merging with another professional services firm because they're wanting to access the Western Australian markets, or in the freight space where they're expanding their line haulage across the states, they're looking to merge or acquire. In one instance, a client is very dependent on its IP, so it's looking at a vertical integration into an acquisition of the IP platform that underpins their business. So there is a lot of activity going on. I'd expect what we're seeing in the middle market, small to middle market. We're seeing quite a bit of that activity, and then it's a case of finding the right capital solution to be able to make that acquisition, because using balance sheet equity is limiting, and so we need to be able to marry those promoters, those businesses. We need to be able to marry them up with the right financial solution, which has the cost of capital that generates growth in equity over time. So seeing a bit of that.
Yeah, okay, that's interesting. So I do know that as there's more credit funds about the place, some of the old traditional enterprise value lending is being picked up by some of those credit funds. So that's very interesting. Andrew, I know that that the phone rings in your office occasionally with when there's an M&A on and someone's trying to get some of the equipment done. So are you seeing much in that? Are you seeing many of your clients selling businesses, like selling their own business or buying other businesses?
Yes, probably a little bit more than usual in that space actually. got a couple of both actually. A few clients of mine selling and a few acquiring as well. There's a little bit more activity than average, I would say, at the moment. Yeah, definitely.
And how are you finding the bank's attitude to participating in those deals?
It is a bit tricky to get those done. Certainly a lot of information required, and making sure that every sort of scenario is covered, and other interesting ways of funding it. Sort of a little bit outside of the box these days, and it really depends on who you get the deal in front of, and often that is even within one particular organisation, depending on the consistency. There is a little bit different from time to time.
Yeah. Okay. All right. Well, so you're seeing people piling into buying stuff because they're worried about interest rates going up?
I'm not sure if they're worried. There's certainly a little bit of that. There are some people that are worried about rates going up, and they do want to fix that rate up front. I agree with everything that Arthur just said regarding next year and the reasons why. Business owners, my client base here, I can only speak for, are really chomping at the bit to get going next year. And the supply chain issue also that Arthur mentioned is a big one. There's approved applications on my desk that you can't jump over. They're just waiting on the equipment to arrive, or waiting on a part or something like that. So that's holding it back a little bit. And also, obviously, you've got the COVID-19. That's got to stay under control, and government reactions to that as well are a bit of an unknown. And if all of that goes smoothly, then I can see next year being a growth year, I think for most businesses.
Okay, we've got our friend Jim Psaltis making his. Jim's not happy with the state of things on the ground. Recovery is not as expected. Restaurants are not busy. Retail sales off a low base still have a way to go, and the RBA is in denial as inflation is biting hard. The banks are poised to rise rates outside the RBA cycle. Now, certainly the banks, I think CBA and Westpac, I don't want to misquote or point fingers, but they have been raising their fixed rates on mortgage debt, on property debt. Are interest rates staying flat, Andrew, on motor vehicles and plant equipment?
No, you're seeing some increases in those rates at the moment, starting to creep in, because obviously the cost of funds is in that pool has been gradually increasing over the last probably 6 months or so. So definitely rates in plant and equipment finance are on the way up at the moment. I don't necessarily think that is a terrible thing. Because they've been incredibly low for a long time, so I think there's certainly a little bit of room to raise them a little bit without.
Well, I think
sound like I'm on the side of the enemy, No.
I mean, there's a whole discussion around how there's a misallocation of capital when interest rates are the way they are, and you've got all this government intervention and central bank intervention, but that's for another day. But it does distort asset prices, and we're seeing that with property prices going through the roof. Whether or not they've eased off, I'm not 100%. But I must say, I was of the view that inflation was out of control, and that all this talk of supply chains influencing it was a load of nonsense, until 2 weeks ago when I had a discussion with John Phillips. I don't know if you saw that episode of Lunch Money, but he's a supply chain expert. And listening to him, I mean, things are genuinely clogged up. They will be clogged up for the next 12 months, but they will unclog at some point in time. And there are some people that still debate whether or not there's going to be some deflation. But look, we're out of time, guys, believe it or not. So, and when Arthur, we didn't even get to talk about Midnight Rambler. We are going to show the Midnight Rambler, which is that's you hanging off the side of that thing back in 1998, and that's after you got tossed over by 70 foot waves, was it?
Well, they measured the waves over 100 feet in certain instances. But, it was a cyclone, Nick. Very difficult conditions, and we sailed through that, came out the other side, and there was still some top boats competing, and we went on to win that race. So it was you went from the depths of thinking this could be the end to coming out the other side and then winning the race, which is always in any sport, it's one of the pinnacle events to be able to win. So that was a extraordinary time. Changed my life, I have to say. Happy to come back and have a chat with you at some point about those experiences. We did one recently with the Union.
The CYC.
Well, no, the Western Union, the foreign currency specialist.
Oh, okay, yeah, sorry.
They just did an interview with me, and we talked about how the lessons of that experience can be applied into the corporate world. Because at VMG, that's what we're trying to do, is help people through the let's call it navigating through the storm to get them to the other side, which is what it's all about, really. And I have to say we're in a fairly stormy conditions at the moment. Notwithstanding that things are hopefully the sun's starting to come up and things getting a bit better.
It'd be great to talk to you about that. I mean, the metaphorical parallels are incredible, aren't they? The storm and surviving and all that sort of stuff. And you've done it in real life, and not only survived, thank God, but you went on to win, which is just absolutely remarkable. And I guess another thing, another sort of metaphor, if I can tease it out, is, I remember an old friend of the family. I remember him talking to me once about sailing, and obviously you've done it. He was talking about sailing in the Sydney to Hobart, and he was saying how the captains, they could somehow knew where the breeze was going to come from. It was like a sixth sense, and they'd be doing something that looked a little bit crazy to everybody else. But I guess the parallels in business are the same, aren't they? I mean, you've got to you've got to be able to tell where the breeze is coming from or where the danger lies. Andrew, look, congratulations on your massive win. Not quite surviving a cyclone. But,
I was just about to say it's a tough act to follow. We're pleased with our CAFBA award. Yeah, it was certainly it was a bit of a come down from a Sydney to Hobart win.
A remarkable achievement, nonetheless, particularly given I know some of the excellent firms that you've been competing with, and also given that if you started at a time when you must have thought, what the hell did I do that for? So, all right, gents, look, really big thank you for coming along and giving our audience such an interesting discussion. And I look forward to speaking with you again soon. I look forward to speaking to our audience again soon in a couple of weeks. Cheers.